Good morning, traders and investors. Thanks for tuning in to Pre-Market Prep with StockOdds. Let's take a look and see what the S&P futures are doing here. We're currently sitting just under flat on the session, a couple little small dips and bounces out of some news out of Russia. So we're currently sitting at 41.48, down 0.1%. The dollar, that's up 0.1% at 101.65. Bonds, those are down 0.4% at 129.24. Crude, that's up about 0.5% at 77.77. Wow, look at that. Gold, that's down 1.5% at 1,989. And charts won't load, but hey, there you go. Silver, that's down 1.1% at 25.10. And Bitcoin, that's pretty much flat on the session at $28,080. So it's Friday, but not only that, it's the third Friday of the month, and we all know what that means. Don't we, Rob?
It's a ordinary monthly expiration, but April, you're sitting in the middle of earnings season as well, so that always spices it up a little bit. We have quite a choppy session. It's rolling up and down pretty dramatically there. I mean, the overall range isn't huge, but the rolls are there. So
yeah,
you
we've
don't
definitely been in a
make
range. Yeah.
What's that?
Oh, we've definitely been in a small range the last week or so. Yeah, even given that it's earnings season.
Yeah, well, let's see here. I'll share the screen. So because we're doing the weekly lists as well, it's always interesting how you open the week with the SPY or other market ETFs and where you end. And so here's the open on Monday the 17th. So if you were putting symbols on, that would be where you're at. And look at that, we're just about the same, right? And
Right
we've
back to
been up
Monday.
and we've been down. We didn't go this way too much. This is the lowest we've seen so far since Monday, but it's a choppy session and it is expiration. And a lot of times with expiration, you get that initial move and then quiets down and people take off and kind of thing. But it's rolling up and down, so we'll work with it.
Yep.
But
Certainly will.
just a reminder again, if you're doing swing trades, you've got to use the market wherever you can. And a key review here is look at that gap up on the morning of April 18th, right? And so that would have, if you had a basket of longs and shorts, that pops them up there, either for you to add to a position or subtract at a profit.
Yep.
And the
Could
key
add to
then
some shorts.
is,
Yep.
yeah, and the key then is, maintaining the balance of capital. There is some argument that when you're opening at such a premium like that, you could lean on that morning high at some point. This is 30 minutes into it right here. You could lean on that high and say, if it breaks it, okay, I'll start to add some weight on the long side to protect my short capital. But if it keeps pulling back and it has an opportunity maybe to fill the gap, I'm just going to stay extra short. So how you get extra short would have been you took some stocks off at a profit that hit your profit target or were just priced to perfection or whatever. Or you could have added to your short side stocks that were gapping up that you wanted to get extra capital short. In any case, you have gone to more short dollars than long dollars would be the natural outcome of a gap open like that. And how
From a
you play it.
market neutral position to start.
Well, you would have come in the day market neutral.
Yeah.
But you want to take advantage of the gap open. Right?
Yeah.
So this is what I'm
Exactly.
trying to teach with the swing trades. You can have a mentality of put it on at the open on the Monday, and you might do a 3-day swing trade, or put it on at the open and do a 5-day swing trade. And yeah, you could sit through all of this And the variance is actually quite low when you have long and short dollars. The variance is really quite low. I mean, it's not like things get crazy on you compared to somebody just sitting there naked long, no hedges.
Yep,
So the variance is
exactly.
low, but the variance can be low and you still might not make any money. So how do you make money? You add a production element when warranted.
Hmm.
And that production
Yeah.
element can look like two things. It can be adding or subtracting, because if you get a chance to add, you're looking for a reversion to the mean. If you get a chance to subtract, you're looking for something else to put in its place. So if you took off a bunch on this second day of your 5-day swing trade, you'd be scrambling to say, okay, maybe I can come up with some 3-day swing trades to put them on and, uh, take them to the Friday, right? It's better to close it out on Friday and not take over the weekend, because weekend risk is not just one unit of risk. It's more like 3 to 5 units of risk, because that's when a lot of things happen. Deals are made,
Whereas,
mergers, golf
yeah,
course, geopolitical wars start, all kinds of things go on, right?
yeah. Whereas like a usual overnight session would be 1 unit of risk. Is that what you're basing
That's
it
what I'm
off of?
saying.
Yeah.
Yeah. If you just
Yeah. Okay.
overnight, it's 1 unit risk. I mean, not every day is equal. We've just discussed this before on the show. The safest night to take, you know, um, stuff has historically been Tuesday, although we have so much resting on the CPI numbers, right, or
Mhm.
FOMCs or whatever. So it can change when you get those type of events during the week. If there's no economic news of concern, then you just got to pay attention to the Fed banter from all the non-voters or the voters or whatever, because we're getting that pretty regularly now through the week. Different Fed members, FOMC members, um,
Mhm.
but not all of them are voting. So sometimes the market ignores that. Um, Anywho,
Yeah.
this just
Options expiration. Yeah.
yeah, this just shows you the production potential, and yet we haven't gone anywhere, right? We're right back to where we started. Okay. As of right now, actually. Okay. Now, yeah,
Okay.
let's pivot over to this is Expiration Friday. So, in our Seasonality Almanac, there's a bunch of symbols long and a bunch of symbols short. Now, what I like to look at is this down here, because this kind of tells you the sentiment, the skew. It seems that within the universe of 219 stocks that's coming up here, if you move the sliders, that would change. But it's bringing in 219 stocks. That's a fair amount to work with. That's fine. Liquidity is there on most of these, so we're good with that. And some of these symbols don't exist anymore. Like, for example, Twitter is here. It doesn't exist um, because events have happened. There's a couple of them. I think there's three or four of them that don't exist. Anyway, the seasonality, it's looking back at last year and the previous years. So obviously Twitter was there last year.
Hmm.
So that's why you're
Well,
seeing it reflected here. Okay, because seasonality is what has happened in the past. It's a little bit different than the other sort of predictive analytics, which say, we're looking at what will happen tomorrow, open to close, based on what's happened in the past. This is more like this is just what's happened in the past, and so the odds are related to how many times it moved up or down, and how by how much. Okay,
right.
so that's
Right.
why
And
that's why some of these symbols don't exist, huh?
yeah, just the events filter there, near the top, it says, between 5 and 8. So this is filtering for, stocks that have had, it's taking at least, 5 Aprils, or the Friday expiration in April,
Sure.
between 5 and 8 of
Right.
those instances, and then
Right,
drawing
starting
those
from
stats.
last year, right?
Yeah.
Right,
Yeah.
so you can't go forward in the sense of like like this past January is now included in the data. So that's
Yeah.
up to date. The past February this last February is now included. Last March is now included, but not all of April yet, because we haven't been to the end of April. And so on. And so when you're looking at May and June and all that, you're actually looking back a year and then the history before that. Okay.
Mhm.
But anyway, I wanted to point out these symbols, just a simple exercise. We talked yesterday about the 0.1% return on capital, right? We said there's a lot of things within StockOdds that point to that. There's
Mhm.
a lot of different types of signals. Seasonality is obviously one of them. But it's not a situation where you're going to get a 10x on your trades every day. It's a small amount, but doing it long and short, you're insulated. You've got low variance, and you can have it like a production line, like a utility type business. Okay, we spent a bit of time on that yesterday.
Mhm.
So let's do an exercise here. So I just took all of these symbols, like see with Vertex here, it's 50, it's 50 odds. So it's kind of on the fence, but look at the performance, right? It's obviously had some massive events in the past. How many events were included in this? So
It's
there
like
was a full
8.
eight,
Yeah. Mhm.
right? So four of them were up, four of them down, but obviously the up ones were exceptional,
Mhm.
to get that kind of performance. So let's just take all these symbols and all of these symbols that qualify that are in existence today, and let's just look at the performance. How did it do? So I'll bring up my sheet here. So this snapshot was taken at 10 a.m. Eastern time, so hour and
About an
15
hour
minutes
ago.
ago.
Yeah.
Yeah. So I took that snapshot and just pasted it in here. And we're looking at the change from the open, because if you were going to put them on at the open, one thing is you could look ahead because the seasonality is there, and you could plan from the day before. You could say, hey, we're getting a great close on this on Thursday, and it's supposed to be really up tomorrow. Let's take it overnight and hedge it off. That's one option, taking some of these things for a swing trade into the next morning. The other option is putting them on at the open. So this example, we'll just take it from the open. These are their longs. These are our shorts. Now, you'll notice the SPY is in here. And the reason SPY is in here is because it's replacing the other symbols that don't exist, so that we have an even amount of symbols. So that means the capital applied to the SPY would include those missing symbols. Okay, so we
Right.
have 40,000 on the SPY, 10,000 on everything else, a total of 200,000 in capital. Now, if you don't have that much capital, then you do what you work with what you have. But the key is not concentrating your capital into one idea, but spreading that capital out. Right now, you
Mhm.
can do equal capital. Many of the S&P stocks are quite functioning quite well with that even distribution. It doesn't mean it's ideal. I never promised you that equal capital is the absolute way to go, because stocks have different volatilities, they have a different liquidities, so there's different things you can do. But just for an example purposes, and for someone to get started really easily, because you see how easy it is to substitute SPY and just put a number of units of capital on the SPY in replacement of the symbols. It's so easy to work with,
Yeah, it's
right?
nice
And
and
that's
liquid.
how I
Yeah.
want people to start. Just really easy. Market orders at the open, market orders at the close, equal capital. And the key is that you're kind of you're making it on the aggregate. You're not going to make it on any one symbol. It's your aggregate bets. It's all of these, and it's the relative performance between your longs and your shorts. So at that time, 10 a.m. Eastern time, This was the P&L, $726 from the short side and lost $269 from the long side. So that equals a gain of 457, which, Josh, what percent return on capital is that relative to the 400,000?
Yeah, it's just over 0.1%. Yeah,
There you go. There's
exactly.
another example of 0.1.
Mhm.
Now, will that stay all day? I don't know. Some people like to say, hey, 10 a.m. Eastern, market's been open for half an hour and I've got my benchmark. I'm good. I'm done. I mean, that's one idea, is just flatten out. There's going to be some
Mhm.
slippage. You could use the market today. Market's rolling up and down. As it rolling over, it's like sell the longs, hold the shorts, buy in the shorts. Okay, so that you can do that.
Yeah. Well,
Anywho,
so
let's what?
I mean, we all know how, lots of traders make most of their money in the first, hour or so of the day. It's always that first bit of volatility. But is there any type of trend that you find with traders that, more money is made, Monday through Thursday and less on Friday? Is there anything like that you know of?
That's hard to say. I mean, it's different based on the type of events that you're in. Like, for example, last year, June 15th was a real pivotal time. It was expiration, and we came out of that, and we had a significant rally, all the way till August 15th.
Mm-hmm.
So, during that phase, you know, some of those weeks were quite robust and, evenly distributed almost too, in the way that they performed. And that was very different, obviously, than what happened from February to May of last year.
Yeah. Yeah.
So the thing
Okay.
is, like, it's going to be scenario based. It's going to be strategy based. And I found over the long sample that the best traders at any given time are those whose strategies align with sort of the market conditions at the time too. So if you were a relative strength trader, for example, and you like to buy on pullbacks, well, you obviously performed really well when the market was going straight up and had very shallow pullbacks.
Mm-hmm.
That's your strategy, right? And so if volatility was low, the pair traders were probably suffering more, but when volatility is high and you got good elastic relationships, the pair traders do really well, and the relative strength trend traders get chopped up, whipsawed all over the place. So it just depends. Like, the best trader at any given time, in my experience, is strategies align with um, market conditions. And there's one other
Right.
factor, and that is the personality has to be trading the right strategies for them too. You can't live in someone else's shoes. You can't try to put a square peg in a round hole kind of idea. You have to be authentic and true to yourself and trade what you can do, right? Based on your capital, your experience, your desire, how you understand things. So I find a lot of guys that have traded options, they actually like to go and start on the pairs and work within sort of,
Hmm.
statistical pairs. They find that more suitable, right? If they're making a
Okay.
switch from or adding on, equities, right? So let's roll now to 10 minutes before we came on the show here. I took another snapshot. So this is the next one. And it cut our P&L in half, basically. So, now we're down to, just a little over 0.5% return on capital, 0.05, I mean. So, who knows what'll happen by the end of the day. But my point in this is just showing you that, not even being selective, just grabbing all of those symbols, right? We just took every one of them and then
Mm-hmm.
balanced out this side with the SPY. put them in, and right out in the first 30 minutes, you're getting that 0.1% return on capital, slightly over that. And that was also just, doing market orders. So there could have been some of these symbols that, may not have been convenient to get in. But there's another option, and that is, be watchful, look at things or where things are trading, like that region's financial there, on the 10 here. So RF, like it gapped down 3.39% and then rallied up almost 1.5% from the gap open. So it's like it's an advantage long for the day, and you're getting that substantial discount. So what would it look like if you focused on some of those opportunities? That can be something that and there's other things like you can see TSM is hurting us. Well, we've got a lot of concern with TSM, don't we? Like that might be one that you might have vetted out of this list and not traded it because it's cost us $142, right?
Right.
It gapped
Even
down.
though it was gapping down, yeah.
Well, it gapped down and it's continuing down because there's a theme going on with this Taiwan, right? So there's a big concern here, and likely if the worst case scenario happens, that stock is going to suffer, right? So that would be, the common understanding is TSM would be under pressure, and it's under pressure today, and there's a lot of rumblings going on, right? So like you can take a list and you can vet it. I'm just showing you, even just taking everything, you still were getting the 0.1 out of the gate. So hope that helps. It's just another thing for people to look at. You can also, as I think you've mentioned in some of the blogs, you can look for other signals to see if you get some ducks lining up. Like you can go into the other dashboards and see if there's some common themes, and maybe RF showed up in a couple different ones. Well, that would be interesting. Maybe there's a conflict on some of them that TSM isn't, it's on the seasonality one, but maybe it's not on, relative strength or Bollinger Bands or, something else. Okay. So you can always cross check. And if you have the web screener, you have more information at your disposal. You can grab lots of things. You can put this list, you just grab this list and put it into the screener and start going through different signals to see which ones agree with your seasonality. It's that easy.
Yeah, you can then just put on the ones that are the most strong, that have the most stats that are favorable.
So a simple way to do that, to line up the ducks without being, you don't have to be a rocket scientist, is you take these, you copy and paste them into the symbol list, you choose your signal, and you just run that list. And then you sort it by, positive expectation. Grab those, ignore the negative ones, grab the positive, pop them in, because you can export it to a CSV file. So you do that, grab the positive ones, put them into another signal, run that, and then grab the positive ones of that. So you might take 20, and by the time you're finished, you might be down to 5 or 6. That's okay. If there are 5 or 6 good ones that you want to work with, that'd be better than, getting into stuff that, you're not sure about, or where there's conflicts, right? So try to be helpful. That's a quick way to do it.
Yeah, it's an easy way to generate ideas, and the seasonality dashboard is free, by the way, for people to sign up. That link should be in the description after we finish the stream here. And you can explore, see what happens on options expiration, and then another big one is the turn of the month effect, right? At usually on the last trading day of the month, there's some big moves, as well as the, first trading day of the next month. So lots of good stuff.
Interestingly enough, I'm just writing an article for Stocks and Commodities Magazine on the turn of the month effect. And I noticed that like REITs and utilities are opposite of the rest of the ETFs for the turn of the month effect. So for example, most of the other sectors are down on the last day and then they're up on the first day. And these ones are the opposite. They're up on that last day and down on the first day. So
interesting.
You can dig you through it yourself, or look at the article when it comes out. But I think that'll be the July issue probably. So anywho,
all right.
Seasonality is there. There's a reason for it usually, right? There's patterns. If you see a pattern, there's probably a fundamental reason for it. That's what you look for anyway. So turn of the month effect is related to payroll deposits, 401k money, institutional stuff like meeting their net capital computation, and mutual funds redeploying capital on the first day of the new month, right? Okay.
Yeah. Okay. Great stuff, Rob. And I think that'll be it for today. Don't forget to tune in to the closing print with Joel at 3:30 Eastern. As well as next week on this show, I'll actually be showing some of this StockOdds stuff, traded live in an account. So you won't want to miss that. All right. Thanks, everybody, for tuning in.